A group of experts in economics accurately foresaw the financial crisis in 2008, and now they're warning that there might be a prolonged and severe economic downturn. This economic downturn could stretch throughout the entire year 2023 and go on. In this video, you will hear a tense tone in the throat of the economy. Let's start. When people hear the word recession, they often think of the 2008 financial crisis, with foreclosure signs dominating the hardest-hit neighborhoods. However, if a recession occurs in 2023, it's expected to unfold differently. Surviving this potential downturn will demand new strategies and preparations. Before the Great Recession, banks gave out lots of loans to people who might not have been good at repaying them. They used these loans to buy houses, even though not everyone was being very careful about it. What happened was that the value of houses went up too much and too fast, like a bubble. When this bubble burst, it caused a big problem. Banks and people who had invested in these mortgages lost a lot of money because the loans and the things connected to them were now worth much less than they had thought. And now, Nouriel Roubini, chairman and chief executive officer of Roubini Macro Associates, concerned that high levels of worldwide debt could harm the economy. He has stated that it'll be extremely difficult for the Federal Reserve to reach a 2% inflation rate without causing a significant economic downturn. He anticipates that the Fed will increase interest rates by 75 basis points at their upcoming meeting, followed by an additional 50 basis points in both November and December. This would mean that by the end of the year, the Fed's interest rate would likely be in the range of 4% to 4.25%. In a straightforward economic downturn, the S&P 500 might drop by 30%, as stated by Roubini. In a more severe economic crisis, which he predicts, the drop could be as much as 40%. Roubini pointed out that people anticipating a mild recession in the United States should consider the high levels of debt held by both corporations and governments. As interest rates go up and debt repayment costs increase, he warned that numerous financial vulnerable entities, including households, businesses, banks, shadow banks, and entire countries, could face significant difficulties. In his words, we'll find out who's unprepared for the challenges ahead. But because inflation, especially in wages and services, is sticking around, Roubini believes the Fed will likely have no other option but to raise interest rates even further, potentially reaching 5%. Additionally, unexpected problems caused by the pandemic, the Russia-Ukraine conflict, and China's strict COVID policies will result in higher costs and slower economic growth. This will make it challenging for the Fed to achieve its goals of slowing down economic growth and increasing unemployment to control inflation, which they refer to as a growth recession. Talking about the unemployment, in the Great Recession, lots of people were out of work, with unemployment reaching as high as 10% in 2009. In December 2022 job report, it looked like the job market was doing really well. Even though prices were going up, stock prices were down, and the housing market was slowing down. But if a recession happens, more people might lose their jobs. It's tough to say for sure if we'll see those numbers reach the double digits again, but let's not dwell on speculation. What's important is that there are actions you can start taking today to protect yourself from potential job loss later this year. Furthermore, there is some advice to survive as things will grow worse. The advice for investors is to be cautious with stocks and hold more cash. Even though inflation can reduce the purchasing power of cash, its actual value doesn't decrease, while stocks and other investments can experience significant drops of 10, 20, or even 30%. In the fixed income category, it is suggested to avoid long-term bonds and instead consider protecting against inflation by investing in short-term treasuries or inflation-linked bonds like TIPS. So in order to protect yourself and your family from any economic instability, be alert and begin learning about the financial zone.